In the previous video, we learned that the stop order is triggered by the last price. In this video, we're going to take a look at how we can use this information to place our stop order's limit price. Let's have a look. Looking at our open orders, we can see that we have one order currently open. We can see that the stop price is 4,000. The limit price is also 4,000. Now, one thing to note about this order is that this order is not on the order book. If we look at the order book, we can see just here at 4,000, nothing's there because this order is not on the order book. The current situation, or what we have code on the GDAX backend that is monitoring the price of Bitcoin. So that code has the trigger price and it's waiting, monitoring the price. When it sees the condition is true, it's going to issue a limit order on our behalf. The limit order is going to have a limit price of 4,000. Now, what we have just learned is that the actual price that's going to trigger this order is going to be the last trade price. Looking over in the trade history, that is going to be the price. Every time a trade occurs, there's a new last trade price. That's the price that's being monitored. So when that price hits 4,000 or lower, GDAX is going to issue an order for us, our limit order. This information can help us make a decision on choosing our actual limit price, because we know that the market price, the price that we can get, doesn't necessarily have to be the same as the last trade price, and often it is not the same as the last trade price. We talked about in a previous video that the spread, or the actual market price that you can get, can move around without having trades occur. Now, that has really strong implications for our limit order that will be placed at the time that the trigger price is reached. This is because the market price can lead the last trade price. Now, the last trade price is in the trade history, and it is just that. It is history. The current actual price in the market is moving faster than the last trade price. This means that by the time our trigger is hit, the price will probably be lower than 4,000 when our order hits the order book. This means that we're going to have a limit order with a limit price of 4,000, and the market price is going to be below 4,000, which means our order is not going to get filled. That's the warning that we got whenever we actually submitted this order, and we talked about that in a previous video. They said the order may not execute immediately. This is bad because we want to actually stop our loss. That was the intended purpose of placing this order. We wanted to stop our loss at a particular price. How can we remedy this situation given the current information that we have? To remedy this situation, always leave a gap in between our stop price or our trigger price and the actual limit, the price that we're willing to pay. Canceled our current order, and we're going to create a new order in such a way that we can mitigate this problem, where we can increase our chances of not getting stuck on the order book when we actually want to fill. So let's look at the order entry panel just on the left. We have a current price, just get rid of that, and we're going to fill all, and we have a stop price of 4,000. This is our trigger price. So when the last trade is at or below 4,000, an order is going to be created for us. Now, that's that programming aspect of this particular order type. We are programming GDAX. We're saying, GDAX, we want you to do this for us in a programmatic way. We don't want to have to enter this order for ourselves. The alternative would be we just watch and monitor the price ourselves, and then when the price gets down to 4,000, we'd say, we want to get out, let's place a limit order. But instead, we're going to be able to program GDAX to say, do this for us if the price reaches 4,000 or lower. But what we want to do is mitigate the chances that we get stuck on the order book, because we definitely want to get out. We want to get an execution. So what we need to do is create a gap. Now, the larger the gap, the lower the price is that you might potentially get. The smaller the gap, the higher the chance is that you actually get stuck on the order book and you don't get an execution. Picking this is just really up to you. You want to pick something that you're comfortable with. You want to put your stop price a little higher than what you actually want. Say 4,000. You might put your stop price at 4,050 or 4,100 just to guarantee that you get out at 4,000. I'm going to say that I'm fine with 39.50 being the price that I actually get out at. So we're going to create a gap of $50. And if you want to, you can set some kind of threshold for yourself, like a percentage or something like that. One other thing that you might be thinking is, why deal with this limit price at all? Why not just deal with the market price and not even, select this limit price? You could do that, but the reason you don't want to is because with this limit price, you're protecting yourself if, for example, a flash crash happens. Because when you specify market, if you didn't put the limit price, then you're effectively telling GDAX, I will take any price that's available. It could be 10 cents. And if GDAX, if that's the only price that's available at the time, if a flash crash were occurring, then GDAX would fulfill that order at 10 cents. So you want to protect yourself. You don't want to just say, I'll take any price. You always want to specify your price, and that's why we're doing that here. And we want to make sure that we can get out, we can get an execution. So we want to have a gap in between the price where our order gets triggered and the actual limit price. price that we're willing to pay. So now we have a $50 gap, and it's very likely that when the last price trades at 4,000 or lower, there's probably still going to be some bids above our 39.50 that we will be able to hit. So let's go ahead and click sell, and we get the warning again, this order may not fill immediately when executed. The way we have set this up, it's very likely that this will fill immediately when executed. So let's place order, and now we have our order on the order book. We can see we have a stop price. This is the programmed price of 4,000. That's the trigger. And we have the price, the limit price of 39.50. So we know we're not going to let go of our Bitcoin for less than 39.50. And we know that our trigger at 4,000, if Bitcoin goes to 4,000, then our order is going to be created. And this is how you should use a stop order to protect yourself using the limit price. I hope this video was helpful. Please like the video, subscribe, and support this Deep Lizard channel. Thank you.